Hello and good morning, everyone. Welcome back to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. The event-filled week began yesterday with the Indian inflation numbers, with headline CPI coming in at 4.25% year-on-year for May. This also puts India at a nice pace in the global markets, controlled inflation, and good growth prospects. Globally, participants will be focusing on the US CPI numbers due to be released today around 6 p.m. Indian Standard Time. This is also at a time of ongoing FOMC meeting. The rate decision will be announced tomorrow. Good morning, JK. Would like to know your thoughts on Indian inflation numbers and how are you seeing markets before the FOMC?
Good morning, Swaraj. Yes, the numbers sound good, but the point to note is that in fact, up to July, we have a very favorable base effect due to which the inflation number keeps coming down. So, in fact, in July, it can be even lower. Even the core prices came down. That is a good news from 5.2 to 5%. Now, important to assess how it behaves after July, and that holds a lot for the policy approach going forward. Although RBI has projected the full year inflation to be at 5.1%. Now, even 5.1% is way above the median target of inflation at 4% for RBI. Therefore, the any benchmark for rate cut by RBI is still way higher. Along with that, we also had IIP number yesterday, which came at 4.2% towards 1.7% in March. And anyway, see, this is for April, and therefore it's a lot of time gap between then and now. More importance should be given to the PMI survey, which showed a healthy trend early in the month. All said and done, in April, we did see a manufacturing slowdown that, from 5.6% to 4.9%. Overall, as you said, the Indian macros are overall looking good, and it is one of the bright spots in the global economic scenario. Coming to the global markets, we had the risk sentiment, which has been quite positive. Yes, S&P 500 move into a fresh bull trend, and then it is at 20% plus above its October 22 lows. And see, important thing is, while central banks are still tightening, very likely that they may be closer to a peak now. Higher for longer may be the more probable worst case scenario the market is discounting, but probably not much more hikes. Of course, UK can be an exception because of the extremely high inflation that the economy is experiencing. Now, many players are now tending to believe that the recession, if any, will be short-lived and may not be so deep. So yesterday's session saw another up day for all indices, with bulls latching on to the only data of the day. That's a New York Fed survey, which showed 1 year ahead inflation expectations are falling. And in yesterday's trading, the Nasdaq notched up 1.5% rise, while the global composite index of stocks also hit a 1 year high. Now, so the post-debt deal squeeze on liquidity with the market was anticipating has not been visible so far, but it can still arise. So the markets have pushed against this and gained, ahead of the first pause by Fed tomorrow, after raising rates for 10 times and more than a year by over 5%. Now, more than the FOMC rate decision and the dot plot tomorrow, we will be focusing on how the economy performs, and that will be the determinant of whether Fed really goes on an extended pause or not. CPI is expected once again with the base effect favoritism coming at 4.1% versus 4.9%. In fact, there are some indications that say that next month's number, that is June number, which will be announced in July, will be even shockingly lower at 3.2%. But the market is not going to get carried away by this, and they will obviously look at how the core inflation behaves and the super core inflation, where the housing-related services inflation is included. So market impact, bonds did not show any major concern. Again, bonds are not looking at the economic data. They're looking more at the supply of new paper by the Treasury. So there was some small, downtick in the yields more on the longer end and not so much in the 2 year. So hence we saw the yield curve steepening to about 84 basis points. And then important move was seen in the UK gilts, which gained actually 10 basis points to trade at 4.33%. Now, UK yields are the one which is likely to match that of the US very soon, because the forecasts are for a rise of another 1% in the policy rate, which will mean they will hit 5.5%. So UK pound is very well supported. But the caveat is that as they keep increasing the rates further, the economy, which is already showing tentative signs, is going to get really affected. So I think it's something, a conflicting factor. Yield seekers would obviously buy the pound, but then people who look for growth may be disappointed, and therefore eventually pound will have a sharp correction. That is what I feel. Broadly, the dollar remains rangy. Index fell ahead of North American trading, then rebounded as treasury yields recovered, before the 3-year and 10-year notes, large volumes that were auctioned by the treasury yesterday. Of course, we have the CPI data today, which will be focused on for more clues on the yields as well as on the stock market. But point to note is that this rally is also being led by some of the other regional equities, like Japan, for instance, has risen 28% in the last 5 months. So that's a staggering rise. Of course, it's all about valuation. Japanese stocks have been undervalued for quite some time, and Japan has been the longest follower of QE and zero interest rate policy. So, and it's not surprising at all that it has risen like that. And of course, the smart investors have latched onto it. And we had Chinese interest rate decision on medium-term loans, which they cut by 10 basis points. Market was expecting much more. Chinese one definitely reacted to the upside, going up to 7.1760. But then I think if market is already, I feel the market is already overbought on the USD one, and if the sense is that China has already done with its rate cut, we might well see good profit taking in the yuan shorts against the dollar, and that is something which will have an impact on the overall Asian currencies as well. Now we also had a big move in oil prices once again, at falling about 4%. Now again, their demand concerns versus the supply glut. Even as Saudi has announced a cut in July of 1 million barrels per day, so Russia's supply is increasing, and there are rumors that US-Iran nuclear deal might be happening, although both parties have denied. If that does happen, eventually we will have 1 million more barrel of supply in the market, and with the Chinese economy not growing as much as expected, and other economies, there is a question mark about how they will behave in the coming months. Oil is not finding too many buyers. And of course, one of the leading analysts, that is the Goldman Sachs commodity desk, has given downward revision to the oil price forecast for 2023 for the third time, and market is not ignoring those factors. So finally, on the rupee, yes, we nothing much to add. We had another tight session yesterday. Once again, range of less than 10 paisa during the day. CPI unlikely to have much of an impact. Perhaps the US CPI and FOMC will give the much needed movement in the USD INR. But the bias slightly remains to the stronger rupee because the flows are overall in favor of the rupee. Thank you.
Thank you, JK. And I think one theme which I noticed in the inflation numbers is, of course, the impact of base effect for India as well. Favorable base effect up to July is making Indian inflation come in lower. So we'll get to know more how it behaves after July, and something similar even in the US CPI numbers. FOMC rate decision, dot plot, and how the economy performs is something market participants would be keenly looking at, while the other theme is the Chinese interest rate decision. They cut their loan rates for the medium-term loans, leading to a further depreciation in yuan. Now, one interesting topic which I want to touch upon is the debt ceiling. For a couple of months, we have been discussing about the entire debt ceiling debacle. It had gripped the entire financial markets, and its possible implications have not yet fully played out. So it's important to understand how different markets will perceive the debt ceiling issue. So do tune in today for a session on debt ceiling and its impact on different asset classes. It's being held at 5 p.m. today, and it's going to be a good one, guys. So do check out the link in the description and be sure to tune in at 5 p.m. That's it from us today. See you all tomorrow with another round of fresh updates. Thank you so much for listening.